All right. Team Blue Shirts. We definitely all are representing Plena Wealth today with the same uniform on. How are we doing, gentlemen?
I am doing well, Jay. And how's Craig up there in Kelowna?
Pretty good at it. Yeah, I don't know if we all plan blue shirts, but Jay, when you kind of get to our age, there's three colors that you wear: white, blue, and black.
I'm just curious why Jay's got us scheduled here. Well, the FIFA Morocco France game is on. If it's not golf, I think Jay's not interested. But so let's speed this up, sir.
Okay, we'll catch the last minutes of the second half here. So, episode 31, Wealth Talk. We are officially halfway through 2026. What stands out about these last 3 months or the first 6 months of the year with regards to the markets?
We probably sound a bit like a broken record that here we are yet again talking about Canadian and US, and I'd throw global markets into that as well. Equity markets, to be sure, here is they're breaking out to new all-time highs. And I think, again, that continues to go against the grain of what most investors continue to believe. The tends to be the focus on geopolitics and displeasure with certain administrations globally. But again, the underlying message that we've kind of relayed is the equity markets are certainly singing a different tune, whether that's driven by our earnings growth, by the AI build out that continues to be challenged, that narrative as well. I would probably point more specifically over the last couple of 3 months, some of the inflationary pressures that we felt back in the first quarter and the beginning part of the second quarter seem to be alleviated a bit. Data indicated on that. No hidden secret. You go to the gas pumps, their prices are a bit lower, still elevated year over year, but they're lower. Economic data, somewhat mixed, but I'm not going to say it's bearish or anything to be concerned about. So I think it's kind of still part of this muddle through economy that's driving equity markets higher. And it's certainly equity markets, it's not just being led that we've talked about as a team by technology or AI. You're starting to see this expand to different areas of the market. A standout for our clients and for Canadian markets have been Canadian financials, the likes of Royal Bank, TD, BMOs, CIBC. Here we are essentially trading at all-time highs.
It's interesting. I was going to say, interesting you bring that up, Craig, is that you look at the Canadian banks at all-time highs, and to me, it seems like a little bit of a disconnect where, technically in Canada with two negative quarters of GDP growth, we're in a technical recession. It may not feel that way when you're out there on the street or you're out shopping or at restaurants, but traditionally in an environment like that where we have recessionary forces, Canadian banks struggle with potential for loan losses. And if you look at the Canadian banks, I mean, not only are they on all-time highs, if you look back at the performance year to date, but over the last 12 months, some of these banks are close to doubling in price over the last 12 months. I mean, I've never seen Canadian banks provide that kind of return in a 12-month period. I mean, maybe coming out of the bottom of the financial crisis in 2008 when they had fallen 60% and they had a quick recovery. But to me, it seems like a disconnect. And you look at valuation of the banks, Royal Bank trading at a price to book value of 3, where traditionally it's about 1.7 to 2. Dividend yields less than 2.5%, where traditionally banks are 3.7 to 5.25%. I'm curious on your thoughts on that. To me, it seems like a disconnect, particularly on the financials. They're saying something completely different than what the economic numbers are showing.
But yeah, I'd maybe point to a few things. You mentioned loan loss provisions. If you look at maybe positioning over the last year, 2 years, with this fear of what's happening in the mortgage market, that banks are going to be impacted. Well, the last few quarters, you actually haven't seen any signs of that materializing. So, the fear of that, I think, has subsided for the most part. If you look at kind of segment by segment or division by division, capital markets and investment banking, I think, continues to fire pretty solidly. Wealth management, given the activity in equity and fixed income markets, they're performing well. I think the retail side of things, the banking side is doing okay as well. So, the banks are more than just lenders and more than just depositors. a business like RBC or TD, they're far more diversified than that. And I think that's what's being priced in as well.
I'd say to some degree, there's also just the fact that Canada is an incredibly narrow market, and as some of these other sectors that have underperformed, particularly this last quarter, whether it's in the gold or the mining space, that money's got to go somewhere. And if you look at the top 10 holdings on any of the biggest Canadian mutual funds, probably at least four, maybe five of them tend to be Canadian financials. So that money tends to gravitate out of one sector, and a lot of it does just land, in the banks as top holdings.
But does that justify that kind of performance? Like, can that be defended, that kind of performance, or justified to maintain those values when we're seeing them like not only at all-time price highs, but kind of two standard deviations above their traditional valuation ranges? We don't have to answer that there. I would just kind of throw that out there as a observation in an environment that seems a little like you said, kind of, Craig, muddle through. I would say it's muddle through with some signs of murkiness a little bit. Just my view on that.
Yeah, and maybe for the next few quarters, you see prices consolidate for the financials in particular around these levels, and there's a tendency for people, the talking heads on CNBC and BNN, to be one direction or the other, up or down. Well, there's the third direction that equity markets can travel, and that's sideways, and that's consolidating some of these gains. And maybe that's not such a bad thing that we see develop maybe for the next 6 weeks as summer rolls on here. But to answer your question, Jay, going back to why are equity markets doing well, I still think it's a cash sitting on the sidelines. I think here in Canada, fixed income, although relatively safe, in particular investment grade fixed income, I still think equities offer a pretty compelling investment opportunity and option for most retail investors.
That wall of worry that we often reference is still very much alive and well, whether it's the conflict in Iran, which is all of a sudden back on after a 2-week reprieve and ceasefire. It seems like it's warming up over there again. We've seen the price of oil come down, thankfully, with that. But there's enough going on out there. Technical recession in Canada, south of the border, all of the antics happening geopolitically, those issues. There's enough for investors to remain cautious about, keep that cash on the sideline, which paradoxically tends to be the environments where markets do perform well. As we've kind of said many times in the past, it's when you don't have anything to worry about is when you really should be worried as an investor, when it's nothing but blue sky. Here we are today, and unemployment rates are still, kind of humming and hawing, but generally in Canada, not as strong as we'd like them to be. And in the US, where they're still running, pretty much at an all-time or a level of unemployment that is very constructive in terms of the economy. You've got a lot of good things happening, but enough bad things are still kind of lingering out there that it creates a good environment for stock prices to do well.
Yeah, and Clark, maybe you can elaborate, pick up one thing there. Jay just mentioned the technical recession, and certainly we're not economists, but that is a lot of the economic chatter we've heard over the last few months. Is Canada really in trouble? I guess, is that the question, or are we part of this muddle through environment? Or some of these recent announcements we've seen from the federal government, pipelines and bailouts, quote unquote bailouts in Vancouver real estate. Are those the signs that we're in trouble, or are those potentially the signs that we're coming out of it on the other side? Any thoughts there?
My view is that the headlines are indicating a lot of, Canada continues to be in trouble. I would argue that we were in trouble, in the last administration, if you want to call it that, over the last 10, 12 years. And we've got kind of a new approach to things, or at least one that looks like a new approach that looks promising. But there's a transition period of getting from there to here, or there to there, in a sense. And I think that We have a lot of good initiatives on the table, but I think it continues to be the same problem in Canada. And these are problems that don't correct themselves overnight. So we've got, extremely low productivity relative to other G7 countries. We've got a housing issue, even though house prices have stopped going up. They haven't come down enough to make it affordable for the average person. We've got, even though there's projects that are being approved, getting from approval to actual, shovel in the ground per se, that takes a lot more than just an initial approval between the prime minister and a premier. So I think, there's hope out there, but again, have we really seen enough that it starts to show up in the economic numbers? I don't think so. And I think, obviously there's a hope there, but there's also still a lot that can go wrong.
Yeah, and you talk about housing and how many times we reference it on this podcast. That's deeply rooted within Canada's challenges here is the amount of debt that we carry, and we're seeing some of these cracks emerge, whether it's here in the Okanagan with some properties that are being sold at what is perceived as a pretty significant discount. And for you guys in Vancouver, the more recent, again, as I mentioned, bailouts. Now you're starting to see government step in and potentially look at, partnering with the private sector in an area that, has kind of been the backbone or the perceived backbone of the Canadian economy. I don't know which way to take it, but to me, it's signs of more trouble ahead as opposed to an optimistic approach, in particular to real estate.
Yeah. One of the things I hadn't thought about until recently, just to kind of go back a little bit to the housing market and kind of its effect on the economy is, when you think about an economy and GDP, in the US, what is it? Consumer spending is, 2/3 of
Yeah.
GDP. And, relative to the United States, where you have a low cost, when I say low cost of living, depending on where you are, low cost of housing relative to most places in Canada where you have a high cost of housing, whether it's, the cost to purchase a house or to rent. If you have, as we do here in Vancouver, the majority of your household income, in some cases upwards of 70%, going to service debt on a home or for the cost of rent. Whereas in some places in the States, housing is so affordable that people, it's 20% of their household income. The rest of that money that's not going to housing goes to consumer spending or goes to savings and investment. And I think that's one of the biggest issues here in Canada with the cost of housing that I hadn't really appreciated was we just don't have enough left in our pocket every month as Canadians to go out there and do the spending and stimulate the economy as much as other areas do. And I think until that problem is corrected, that on its own is a significant headwind to, substantial economic growth in Canada.
Well, I think that also goes back to tying into the lack of productivity growth, and really productivity growth is another way to describe capital investment on the business side of things. When businesses are operating and so much of their cash flow is going towards the cost of real estate that they're using, whether it's through the rent or through the mortgage that they own on their property, that restricts how much capital they can reinvest into their businesses. And so it does the same thing on the business side of things, and really, adds not only to who can buy those products and services, but how efficiently those businesses can create those products and services.
Yeah. So what should our listeners really take away from, we mentioned this, these federal programs are being announced to support real estate. What should they be taking away from this? Is it a sign of more friction to come, or is it something that we should be concerned about?
I think one thing to take note of it is exactly what we're talking about is the government's acknowledgement and recognition on how important the real estate sector is to the economy. And kind of a notion like we saw 15 or 20 years ago in the States with the financial industry, how it's too big to fail. And I don't necessarily support that. When you see bailouts of developers, if that's what you're referring to, that extended themselves too much, that got ahead of themselves, that built way too much supply in an environment where the cost to build were higher than average. That's not my fault as a taxpayer. And
that's the debate, right, Clark, is, do you let free markets take care of itself, or do you have government intervention like is being proposed? And I think there's two sides of that conversation, right? Is do you let markets take care of themselves and real estate prices fall another 15-20%? Who takes the risk? Well, some people will view the developer should be taking the risk, as opposed to the taxpayer. As you said, the taxpayer takes the risk and steps in now. What does that look like on an ongoing servicing basis? Who pays for the maintenance of that property? Who pays for the taxation of that property? Who pays for strata fees if that's the case? It's going to be perpetually on the taxpayer.
the other side of that is that if you take the risk out of the equation for the developer, keep in mind these developers, here in Vancouver, they're generally backed by very wealthy families that have made their wealth through the exact opposite, which is a really frothy real estate environment and government support and a lot of demand for housing. And they did that by, theoretically taking on the risk so that they can enhance their wealth. And if we get to an environment where those risks that they took on to generate their wealth start to play out, why does the government backstop them? What kind of behavior does that create or encourage going forward? Is, hey, we can overbuild, we can extend, we can borrow, we can, whatever it might be, with this notion that, hey, the government's going to be there to backstop us if we screw up. And I think that's a notion that, whenever we see these bailouts, again, whether it was 20 years ago during the financial crisis, we've seen it in other sectors during different periods, is that that's the big argument. Is that right or is that wrong? And there's so many sides to that argument. Like you said, who's going to pay for those extra costs, Craig? But the other side, as I just said, is what kind of behavior like that doesn't manage that risk or discourage that risk. It just continues to encourage it.
And where does it stop? You start that train, and does it, go down from developers to medium-sized business, a small business, to anybody else that's involved in real estate, as we're talking about here. It can potentially set a very dangerous path going forward, of where maybe free markets should just let themselves sort that out.
Clark, you mentioned going back to the financial crisis, bailing out banks, and I think we would all agree, just to play devil's advocate a little bit here, that bailing out the banks when the Federal Reserve did in the US at the time when banks like Bear Stearns and Lehman Brothers were going under and had significant risk to the rest of the economy was probably the best thing they could have done at that time. And really did happen at a time when stock markets were down 40, 50%. And had they not stepped in and done that bailout, who knows what would have happened to the economy? Maybe it would have gone through a much healthier cleansing process. Maybe not. Maybe it would have turned into the Great Depression 2.0. So I think it kind of begs a question, like, if the government's willing to step in now in a way that is so universally unpopular here in Canada on both sides of the political spectrum, and they're willing to kind of take that egg on their face, or whatever the saying is, what is there enough cracks in that kind of housing market in the development community where the banks are starting to worry about their loan exposure, and they were in Carney's ear saying, hey, something's got to be done, like you've got to throw us a bone here or things are going to go off the rails.
As we talked about 10 or 15 minutes ago, when you have banks up 80% in the last 12 months, whatever that number is picking out of the air, the stock price isn't telling you that the banks are in distress or worried about things, because the market isn't. And, I think currently, and I mean, you probably know this story about the bailout of these developers better than I do, but I mean, how many are we counting on one hand? And are they isolated to a certain, geographic area? Is that, I mentioned a few minutes ago, kind of the concept of too big to fail. Is it really a valid argument that the government at this point should be so worried about, two or three developers that overextended themselves, that it's going to have this devastating effect on the Canadian economy that's going to, make the Canadian economy fall off the proverbial cliff? I beg to differ, but I mean, maybe I'm missing something, and maybe the point you're trying to get at, Jay, is maybe that there is a crack that somebody's seeing, the tip of the iceberg per se that somebody's concerned about and saying, hey, look, let's get to this quickly and proactively so that it doesn't become a bigger problem. But if that is the case, it's a big problem if all we're seeing right now is the tip of the iceberg.
Yeah.
And I guess my view is that if it's not the iceberg, it's just an isolated problem. I don't want to get too political about it, but bottom line is, let those that took on too much risk and overextended themselves and made bad business decisions, uh, face the consequences of it. And if that's developers or if that is bank or secondary lenders that extended credit without doing their due diligence or themselves understanding, that sector of the environment, so
Yeah.
be it. And again, discourage bad behavior and excessive risk taking as opposed to encourage it and bailing people out every time we have a problem.
Yeah. Well, as we know, generally when there's smoke, there's fire. So there's probably something starting to emerge here that is more than probably what we're anticipating now. And go back to what you mentioned, Jay. The outcome of the financial crisis at the end of the day was tighter regulation. Now, some of that's been unwound up the current administration, but maybe that's what is needed coming out of this whenever we do or whatever, however this unfolds, is you're probably going to see continued ongoing tighter regulation within mortgage markets, within developers, et cetera. That would be my guess over the next number of years.
I'd agree with that. If we switch gears a little bit or maybe put it in reverse and jump back to kind of some of these infrastructure projects that are being announced and put it in the perspective of the housing market. So, over the last 20 years or so, the housing market and construction has been such a predominant part of the economy. It's exactly what we're talking about. And what hasn't been a predominant part of the economy are infrastructure projects and development. And curious on both your thoughts on this. We're seeing announcements of big infrastructure projects, a couple of pipelines, some other things that were announced by Carney that have yet, the shovel hasn't been in the ground yet. I'm not sure if you guys saw the announcement this morning from Alberta and Meta about Meta building a $13 billion AI data center in northern Alberta. It's something that we talked about, I think, on our last podcast. There's some arguments for and against that. But, there's potentially, if things are done right, there's potentially a lot that can happen with some of these, whether they're private, whether they're P3, whether they're public projects that could actually stimulate the economy and provide some, stimulus to the economy relative to what the real estate or construction market is not doing these days.
Yeah, I mean, I think these are 5 years too late in coming. Obviously, we've talked since we started the podcast about how Canada's economy has underperformed its potential for such a long time now. And whether it's the pipeline projects, the data centers, the port revitalizations, all of these major projects that hopefully will be partnered with the government. I mean, in a perfect world, they'd be done privately, but given the kind of necessary access to public lands in a lot of these cases, there's no doubt going to be some federal and provincial involvement, and these will be job creators. And I think going back to the concerns, at least provincially, and why this condo bailout happened, I believe a large part of that has to be just because of employment concerns, because the construction industry is such a big employer. If we start building two major pipelines that will benefit, obviously, our energy markets, will benefit our independence and the access to different international markets for our resources, but will also just create economic opportunity all along the way. These are really the things that will hopefully start to kickstart our economy and get us back on track where we're not underperforming our potential as much as we have been. It seems like in Canada, given the political climate, given all the groups that are involved in some of these major decisions. You just have to have the federal government involved to ensure that they actually happen. But I have to believe this is going to be positive, whether or not that's a 2027 story or further out. I guess we'll see how quickly they can kind of get these projects going. But I think without a doubt, these have to be seen as positive developments. X the condo bailout, which I think was just the most mismanaged announcement I've ever seen come out of the government. But Craig, what are your thoughts?
This is kind of the news I think we've all been waiting for as Canadian. It has the potential to be a major national building initiative, and I'm encouraged that it's not just Alberta West. I think it's the Northern Gateway. I think it's called from Alberta to Ontario. You're starting to see a little bit more of a national build out plan. I'm quite encouraged. This is the news, or at least the programs that need to be jump started to have some confidence, whether if you're domestic capital looking to invest, or if you're foreign capital, which has been non-existent for 10, 12 years. You need to start to see some of these sparks ignite to have some confidence. Without a doubt, Jay, as you said, it's going to take time, as these always do, and that's probably going to be some of our biggest challenges, is getting through some of the red tape that has prevented a lot of these projects in the past. But it took more than double the original proposed budget to get the Trans Mountain built, but eventually got built. And that's, in my opinion, that's been a success. So the initiative is there. I'm encouraged by it. And I really do think that's what we need to start to see here in Canada, is the attempt to build stuff out like this. Because this, as I said, is a major advantage to all Canadians.
And I think for those
economically, I should say, it's obviously going to receive debate, but economically, that's where the win is, without a doubt.
Yeah. Yeah, and I think for those clients of ours that aren't believers in supporting our resource development, I mean the luxuries that we enjoy, whether it's social services, I mean across the board, or just to give ourselves the potential ability to service all this debt that we've accumulated in the last 10 years. Like, we need to get our economy growing at a faster rate than our debt is growing at. If we want any hope of remaining a going concern as a country over the next 50 years. These are just this accumulation of debt that we've seen provincially, federally, everywhere you look. We have to find a way to pay that down, and the way that we're going to do it is by growing the economy. And some of us might not love the resource development that's taking place, and the promotion, the complete heel turn by the Liberal government on their kind of policy when it comes to the development of hydrocarbons. But at the end of the day, that's what Canada's got a lot of, and that's what we're good at. And I think the idea that a cleaner global environment is dependent on Canada exporting more of our natural gas is something that is undebatable. If we want to stymie the growth of China's coal industry, we should be exporting as much natural gas to China as we possibly can.
And Craig, you mentioned there's a lot of debate about this stuff, and Jay, it's what you're hinting at here is the environmental side of it. And I think that we talked on our last podcast about, I mean, anything you do these days, you build, there's going to be an environmental side, particularly on the hydrocarbon side. It came up on our last podcast about these data centers, these AI data centers, and I think that there needs to be a desire or an objective of striking the right balance between economic growth. You can't ignore the environment. You have to balance that with doing it environmentally correct. And, as you guys know, I was just last week in Eastern Washington or Southern Washington, and we drove through a town called Quincy, Washington. I mean, it's in the middle of nowhere. I think it's known for having 2 jails. And we drove by and we saw these huge buildings. They look like Amazon warehouses times 10. And at first we thought that's a huge, like to say it's a 3rd jail or whatever. But doing some research on online, it was like these are all these data centers. So Quincy, Washington, I think in the northwest of the United States, has got the highest number of these AI data centers. And they weren't, I mean, to some degree they were an eyesore, but from an environmental perspective, they're all built right on the Columbia River. So the Columbia River, of course, comes out of BC. It's our water as well. There's a ton of water in that river, and that is what they're doing to, the cooling and the need for water. What was also interesting is each of these facilities had what looked like their own power plant next to it. And these power plants were, there's wires going all over the place. These power plants were powered by, in a very rural area, solar panel after solar panel after solar panel, and wind farms as well. And it's, to me, I kind of took that as a sign. And by the way, that little small town is a pretty vibrant area now from an economic perspective. And, to me, I looked at it and I said, although, hey, it doesn't look as pretty as vacant raw land as it probably did 20 years ago. To me, it looks like, they've started to do things right from that perspective, created some economic growth and done it in an area and done it in a way that has been somewhat sensitive to the environment as well. And I think it's, just an example of where I think as a country we could take it, whether it's on our hydrocarbon side, whether it's our use of water, et cetera, et cetera, et cetera.
Yeah. Yeah. It's tying it all back in. These are all kind of these green shoots that we often talk about in this industry of some potential, economic wins that we can have here in Canada, early stages, but let's take it for what it is, as a win. And we need to see that. We talk about inflation and why we've been so behind here relative to G7, G10, G20, whatever you want to look at. It's reflective of our Canadian dollar. Here we are talking in July at 70 cents, 71 cents. Again, it'd be nice to see the Canadian dollar at 75, 80 cents and have some confidence in it. This is, again, I think the momentum that we potentially need. So despite how kind of critical we've been over the last 31 podcasts of our government here, maybe we're starting to we see a bit of silver lining here, or some blue sky ahead.
Definitely. So halfway through the year, anything we should be looking out for the rest of 2026? I know midterms are on everyone's kind of minds down south, but what should we be watching for here as we move through the rest of the year?
I don't want to be the glass is half empty. I'm generally not, but I do think, we talked about it as we started this podcast this month or today, that I think there's some signs out there. I think that we're not big market timers. I always tell people our crystal balls are not clear. They're murky sometimes. But I think sometimes you get a gut feeling that to some degree it's time to be cautious a little bit. When you see valuations of certain things, when you see, Canada dip into a technical recession, where you've had markets come so far so quick. And that's me. I mean, you guys might disagree, but I wouldn't be surprised if over the next 6 months, there continues to be some good news as we've seen. But I also think that there's some signs that, and we talked about cracks emerging in the development market in Canada, that I think an expectation that not all good news for the rest, all news for the rest of the year is going to be good. We might continue to see some cracks emerge in some areas.
Yeah, my takeaway maybe is a message I would say is, I think patience again is always a key theme that we relay to clients, and by that I mean, if we do see some headline-driven news day over day, be patient with what that news is stating. As you mentioned, Jay, the last couple of days here, we've seen a little bit of the reemergence of some political strife in the Middle East again. I think, don't get caught up in that. I think being selective, if you've got cash on hand, being aware of where valuations are rich. You point out the Canadian financials, Clark. Maybe you look for some potential consolidation or weakness in some of those names if that's the case. But cash is also seen as an asset class that maybe holding a bit of extra cash for the time being isn't such a bad thing.
And just to be prepared, generally midterm years, we do see volatility leading up to the midterms, which don't be surprised if it happens. And as I echo your remarks, buy good companies and hold them for long periods of time and tune out the news is generally the playbook we will continue to follow. So I think that's pretty good for today's conversation. So hopefully brought you some interesting perspectives, and wishing everyone a happy rest of the summer. And we'll see you in about a month's time.